Now let's take some time to apply what you've learned by recording transactions 1 through 5 from the garden spot case. In the first transaction, Mary Jo met with her lawyer to incorporate the business, and she and Josh, her husband, invested $60,000 in the company in exchange for shares of common stock. They had thought about borrowing the money from her mother, but they eventually decided just to take it out of the savings account that they had accumulated over the past 10 years. I've outlined a structured workspace for us to use. It includes the balance sheet equation at the top. The bottom left-hand box will be where we'll write our journal entry, and then we have the additional workspace where we can put our T accounts. Remember, there are 4 things you've got to know in order to be able to record the journal entry: the accounts affected, the type of account, whether it increases or decreases, and the dollar amount. With this transaction, the company sees an increase in cash when Mary Jo and Josh invest in the company. So I'm going to record an increase to cash, which is a left side entry or a debit because it's an asset account that's increasing, for $60,000, and a right side to an account called capital stock, which is an owner's equity account. It increases by $60,000. Let's post these to the T accounts. We'll need a cash T account that I'll put here because it's on the asset side of our workspace. And we'll need a capital stock T account, which I'll put here in the owner's equity section of our workspace. Of course, we're just getting started, so these have no transactions that have hit them yet. So we have a beginning balance in each account of 0. Let's post the journal entry to the T accounts. We need to make a left side entry to the cash T account for $60,000. I'm going to put a 1 out beside that entry to note that it was associated with transaction 1. We need to put a right side entry into the right side of the capital stock T account. And of course, I've also included a 1 out beside that entry to denote that it was associated with transaction 1. Now remember, we always like to make sure that the balance sheet equation stays in balance after we record a transaction. So let's check to make sure that's the case. In this transaction, our assets increased by $60,000 because our cash balance went up. And our owner's equity increases by $60,000 because our capital stock balance went up. So both sides of the equation increase by $60,000, so the equation stays in balance. And we're quite happy about that. Now, what if Mary Jo had borrowed the $60,000 from her parents instead of using her savings account to get the $60 to invest in the company? The transaction that we record would be no different, and here's why. There's a concept that we'll call the entity concept, which tells us that what we want to do is report financial information only for the entity of interest, which in this case is the garden spot. So let's draw this area will represent our company, the garden spot. Now recognize that Mary Jo is affiliated with the garden spot because she's the manager. But she also has another affiliation with the company. She and her husband Josh are the investors or owners. They gave the company $60,000 in cash, and they received stock of $60,000. But they could have been anybody. The investors didn't have to be Mary Jo and Josh. They could have been anybody. So they're a different entity than is the Garden Spot. If they had gone to Mary Jo's parents and taken out a loan, that would be a loan on their books, not on the Garden Spot's books. But instead of doing that, they went to the bank account and got $60,000 from their bank account and used that to invest in the Garden Spot. So the transaction for the Garden Spot would have been no different. The only transaction it's engaged in is issuing stock to owners in exchange for $60,000 in cash.